Perfect. So I have three colleagues joining me today to cover a variety of topics, which includes Daniel Ryan talking about some practical tips for accumulated other comprehensive income. Stu from our Cincinnati office is going to walk through some asset purchase versus business combinations, accounting, and Ben Phillips is going to discuss how to manage third-party risk by understanding the impact of service providers on internal control and SOC reporting. And then last, I'm going to discuss some recent accounting standards updates with the FASB. Our session objectives today, after attending today, the learner should be able to apply some practical techniques to track and report accumulated other comprehensive income, distinguish between an asset purchase and a business combination, and determine when to apply the appropriate accounting treatment. Be able to discuss how finance professionals can effectively manage third-party risk by understanding the impact that they have on internal control, how to leverage SOC reports and address audit and compliance considerations, and lastly, be able to summarize recently issued accounting standards updates and assess their potential impact on financial reporting. Before we dive in, we're going to make sure that everybody knows how to get these code words in. So code word number 1 is on the screen, again, with the links to how to access Conference IO and where to submit your code words. If you're using the app, you can see how to do that. So first code word is up on the screen. All right, so to hit our first learning objective for today, we're going to talk a little bit about accumulated comprehensive, other comprehensive income and some of the application tips to help with accounting there. So to help with this, we have Daniel Ryan, a director in our Audit and Assurances Service Group out of our Fort Wayne office. Daniel works with clients to help ensure accurate financial reporting and verify that strong and efficient control structures are in place across financial processes. He serves clients in an array of industries, including transportation, agriculture, and veterinary services. So I'm going to turn it over to Daniel for our first topic.
Yep, thanks, Jessica. As Jessica referenced, my name is Daniel Ryan, and I'm a director here in the audit group at KSM, and I'm going to be going over a high-level review of accumulated other comprehensive income, or AOCI, as we'll refer to it. So we'll start with going over kind of what is AOCI, why does GAAP have this component within our statements of equity and income, what is its purpose, and how does it impact the statements that we report on, and then we'll walk down through some examples of items that can generate AOCI that would require this kind of reporting. This isn't a comprehensive list of things that generate AOCI, but it's some of the more common ones that we see in our client base. And of those, we see a fair amount of debt securities, particularly those that are classified as available for sale, and that'll be our first example. We'll also go into when we have some foreign currency translation items for a company and when that needs to be done and how that could impact AOCI. And we'll wrap up with an example on effective cash flow hedges and how those amounts can flow through AOCI. So to start with, what is AOCI? What is this thing in general? GAAP has basically carved out certain kind of specialized items whose gains and losses will be reported exclusively within the statements of income and equity kind of off on their own. You can think of AOCI as almost a retained earnings of sorts of these special items, and they get reported out separately. The corresponding amount to that within the income statement would be other comprehensive income that is reported outside of net income. Again, these are items that are kind of identified by GAAP that need broken out and disclosed out on their own. They're a part of total equity and income or comprehensive income, as we'll find here in a moment. So they do impact the statements overall, but they are broken out separately in a way that we don't see for most of the items that are reported within GAAP. Oops. If we take a look at an example of a statement of equity here for a partnership, in this first column, we'll see how net income is adding to partners' capital. We're making distributions to the partners, and that's reducing partners' capital, kind of the general items that we see flowing through equity, nothing terribly unusual here. The topic of today's discussion is the second column here that's a little more unusual, which is accumulated other comprehensive income or loss. We'll refer to this as AOCI. Again, you can see how this is broken out from partners' capital. This will be impacted by those special items I had referenced in some of the examples we'll walk through, but it's just a little bit more detailed disclosure of these items and how they impact equity. They are incorporated into total partners' equity over here on the far right-hand side, but again, they just get broken out a little separately. We'll slide down to the income statement here of a similar entity. Again, typical income statement. We're starting with revenue up high. We've got cost of sales and various operating expenses that bring us down to net income. All that's pretty typical. The unusual part here that we'll touch on today is this other comprehensive income or loss, as the case may be, section where we're taking these specialized items, their gain or loss impact in a given year, and breaking that out from net income. Whenever we have AOCI or OCI in a given year, we end up with comprehensive net income, which is the very bottom line there. But again, we're just breaking out these items from typical what we call net income into their own classification. So in summary, AOCI or other comprehensive income on the income statement is simply a breaking out of specialized items within GAAP that are required to be disclosed separately from traditional equity and net income amounts. First example we'll look at here for items that generate AOCI and OCI are available for sale debt securities. Now, what do we mean when we say that? Many times we'll see companies buy ETFs or mutual funds that will hold fixed income securities as an underlying asset, and that's not what we're talking about here. Any investment into a fund like that is actually an equity investment into the fund itself, even though it holds the fixed income securities within the fund. What we're talking about is fixed income securities, whether they be municipal bonds or U.S. Treasuries, corporate bonds, whatever the case may be, that the company holds directly. Maybe they were purchased over the counter or entered into another mechanism, but they're not held within a fund. So that's the first component here. The second piece is when you get into the debt securities area of GAAP, there are different classifications for fixed income securities that get treated differently depending on what the classification is. For example, a company or management of a company might determine that the company has the ability and the intent to hold a certain debt security through maturity. And in that circumstance, the classification of that given security is held to maturity. That held to maturity fixed income instrument is treated differently under GAAP when we compare it to an available for sale fixed income security. Now, whenever we see municipal bonds or companies entering into situations where they have treasuries or any of these other type items, they're usually liquidity for liquidity purposes. Maybe we have excess cash, we're looking to generate some income. So we buy into these fixed income, potentially low risk items to generate some of that income, but we don't really intend to hold it through maturity. And therefore, usually when we see these items on a company's balance sheet, they are classified as available for sale. The portion for this conversation that we're going to talk about with regards to AOCI pertains only to those directly held fixed income securities that are classified as available for sale. The component of those securities and their income that will find their way to AOCI is the unrealized portion. So if we have any interest payments, if we have realized gains or losses on these debt securities, those amounts will be recorded up in that net income line that we saw on the income statement previously. It's only the unrealized portion that will be over an AOCI and treated separately. It's worth pointing out on these items, if we have a credit-related impairment for any of these assets, say we buy a municipal bond and the township declares bankruptcy and we have to impair that asset, those items will also flow through income. That will not impact AOCI whatsoever. Additionally, when we think about kind of the timing of how these things work, we'll have this unrealized component of a fixed income security at the end of the year. Once that security, if and when it is sold or otherwise settled, it becomes realized, that amount will be reclassified out of AOCI and into general earnings or retained earnings, as the case may be. We'll have a little example here to kind of illustrate this more clearly. On the left, we have a snippet of the bottom of an example of an investment statement for a portfolio of investment securities, fixed income securities. And you can see here in the entirety of the portfolio, the company is sitting on an unrealized gain of $36,517. That same $36,517 will flow through to the ending balance of our AOCI amount on the statement of equity seen over on the right-hand side. Again, it's only the unrealized component of these fixed income securities that flows through to the ending balance on AOCI within the statement of equity. Again, on the statement on the left, we're assuming that all these fixed income securities are classified as available for sale. Any other classifications would not impact AOCI in this nature. When we think about the income statement impact of these items, we've got this unrealized loss on marketable securities in the AOCI column. In the next tab here, we're going to see that same $128,000 amount flow through here in the OCI amount. If we think back to the original income statement example that we presented, we've got the sales all the way down to the net loss here in this instance that the company incurred. We have this other component of OCI. The OCI component within this income statement is going to be the change of AOCI at prior year end and between that amount and the ending balance of AOCI at current year end. That amount is what we'll find here in OCI. Again, we'll take the net loss, the OCI impact, and that will come down to our net comprehensive loss. In summary, when we think about fixed income securities and their impact on AOCI and OCI and how they flow through the income statement, we just take the unrealized portion of directly held fixed income securities that are classified as available for sale. That amount will be our ending AOCI balance, and the change in the AOC balance from year to year will be the amount that we recognize in our OCI line on the income statement. The next example we'll walk into has to do with foreign currency translation. This is a situation where we have an entity or reporting unit that operates in a local currency that is different from the reporting currency of the reporting entity. So if we have an entity, say overseas or something that's operating in that local currency, we have to translate that TB as of the end of the year into the reporting currency for reporting purposes. Obviously, we couldn't have the same set of financial statements incorporating pounds and dollars within the same set of statements. We need everything in the same currency. That's the translation transaction that we're talking about. There are transaction gains and losses that are excluded from AOCI. For example, if we're an American-based company, we're reporting in dollars, we operate in dollars, but we buy a piece of equipment overseas, and there's a transaction gain or loss on that transaction related to the currency that we had to acquire in order to purchase the equipment, that would be a transaction gain or loss. That amount will flow up through net income. Again, the portion that's going to flow through AOCI is only that translation piece where we go from the local currency to the reporting currency of the reporting entity. This example is a little different from the fixed income example that we gave previously, where before we were reclassifying the realized gains and losses of debt securities out of AOCI and into earnings upon the sale. There is no kind of equivalent transaction that can happen within the foreign currency translation area. The only mechanism that can remove these amounts from AOCI is the liquidation or sale of the business itself. Therefore, whenever we have these gains or losses that enter into AOCI related to foreign currency translation, they basically sit there indefinitely. They never really get reclassed anywhere, again, unless the entity is sold or liquidated. We'll walk through an example here of how we translate an entity's TB in a local currency and into a reporting currency. At a high level, all we're doing is applying a conversion rate. And the question is, what conversion rate do we use? So we've got an example trial balance here. We've got up top in blue some balance sheet accounts. These will be translated using the exchange rate as of the last day of the reporting period, which makes sense when you think about it. A balance sheet is reporting items as of a certain day. So it then makes sense to translate those items as of the rate on that day. There are instances where we will use the translation or the foreign exchange, the conversion rate as of a historical date. In the equity accounts here, in this instance, we would have had a contribution as of a specific date to initially start this entity. That contribution will be translated as of the exchange rate on that day. And therefore, we'll call that the historical exchange rate, and that will never change. Finally, we'll move down to the income statement accounts here in orange. Those will be translated at the average exchange rate over the period that's being reported, which again makes sense. An income statement is reporting activity over a period of time. So we're going to use the exchange rate on average over that same period to translate these items. After we go through this exercise, we're going to end up with a TB in the correct reporting currency, but it will be out of balance. Obviously, we're using different exchange rates to multiply these things across. The TV will no longer net to zero um, because of the different exchange rates that we're using. That is where the AOCI impact comes in here in this line in yellow, the exchange rate change. Essentially, this amount is the amount that forces the new TB in the reporting currency to balance to zero. This 41,711 will be the same amount that will be the ending balance for AOCI within our statement of equity. You'll see the 41,711 here at the bottom of our AOCI amount. If we were to look at this entity's income statement down within the other comprehensive income amount, we would see this $15,000 amount noted here. And all this $15,000 amount is the change of the AOCI at the prior end to the current year end. In summary, whenever we have foreign currency translation, we're going to use the respective exchange rates that we discussed and the amount that allows the new translated reporting currency TB to balance. That amount there is going to be our ending balance in AOCI. The change in AOCI will be the amount that we recognize as other comprehensive income or loss within the income statement. Our final example here relates to effective cash flow hedges. And what do we mean by this? A company can enter into any number of hedges for underlying assets at its discretion. What we're referring to here are cash flow hedges that hedge the operational risk of a company with regards to assets that impact operations. Another way to say that is if I have an input, say oil, as the main cost of my business, and the rise in oil prices causes a direct correlation to rise in my costs, an effective cash flow hedge would also rise with the price of oil. The rise in my derivative asset would offset the rise in the costs I'm incurring to run my business. That's what we mean by an effective cash flow hedge. An ineffective cash flow hedge doesn't work in concert in that manner, to where it's offsetting expenses against my operations related to the underlying asset. When it comes to AOCI, the only component that will impact that AOCI amount is the effective cash flow hedges. Ineffective cash flow hedges will stay up, their impact on the income statement will stay up in income and not impact AOCI or OCI. In this example here, again, we've got the familiar AOCI column. If we were to look at this entity's derivative statements at the end of the year, we would see an unrealized loss of this $9,607. Again, it's just the unrealized portion, similar to the fixed income example that we gave previously. It's just the unrealized portion that we're showing at the end of at the bottom of AOCI at the end of the year. Once these derivatives mature and are exercised or liquidated, whatever the case may be, those items similar to the fixed income will be reclassed into the earnings column on this equity statement. On this income statement, we can kind of see how this reclass happens. It's laid out a little differently than previous examples. If we start in 2024, we have this unrealized gain on cash flow hedges of $353,463. That would have been the unrealized gain amount on this company's investment statement for their derivatives at the end of 2024. In this example, all those derivatives matured within 2025, and therefore those amounts need reclass out of OCI and out of AOCI on the equity statement. So you see the reciprocal negative number, 353,463, within OCI in 2025. We roll that forward, the unrealized balance of effective cash flow hedges at the end of the current year is that 54,903. Again, that is just the amount, the unrealized portion of the effective cash flow hedges at the end of the year. That would tie to our ending balance in AOCI on the statement of equity. The net other comprehensive income impact is the difference between those amounts, which is the change of AOCI from the prior year to the current year. In summary, whenever we have effective cash flow hedges with that designation, the unrealized portion of those amounts at the end of the year is what's going to show up on our ending balance of AOCI, and the change in AOCI year over year will be the net OCI gain or loss number within the income statement, which is reported below net income. In summary here, AOCI is this other area within our financial statements as required by GAAP to report the gains and losses of these specialized items, some of which we've walked through today. Some of those items get reclassed into earnings once they're realized, but overall, this is simply a slightly more detailed set of disclosures for these certain items that flow through our statement of equity and statement of income. If you have any questions on how AOCI or OCI might impact your financial statements, please don't hesitate to reach out to your KSM representative, and we'd be happy to walk you through how this might work for you.
Thank you. Thank you, Daniel. I'm having trouble getting my video back on, but as he said, reach out to him if you have any questions, but or to your KSM advisor. I know we've seen more and more, especially with the debt securities, people trying to walk through how to account for AOCI, so it's always good to have kind of a reminder there. Our next code word, I know there were a couple of questions about how to get into that conferences IO and where to insert those code words. So there is a visual on the screen now with where you click to do the code words and then be able to type those in. So code word number 2 is 505. When we leave this up here for a second, I'm going to go ahead and talk about our next session, which is distinguishing between asset purchases and business combinations and kind of the related accounting treatment there. And we have Stu, who's going to take us through that topic. We've seen an increase in mostly business combinations, but we've had a few asset purchases this year. So it's a good time to just do a refresher course on kind of the basics of how you determine what is a business combination and what is an asset purchase. So as I mentioned, Stu is going to be helping us with this topic today. He's a manager in the audit and assurance service group out of our Cincinnati office. And through his work with a variety of clients, he helps them strengthen accounting processes, facilitate reliable financial reporting, and enhance internal control environments. He serves clients across several industries, including manufacturing, construction, and employee benefit plans. And we are happy to have a variety of offices represented today. So thank you, Stu, for joining us to talk through business combinations.
Of course. Thanks for having me, Jessica. So as Jessica mentioned, I'm going to be walking through business combinations. So the difference between a purchase of an asset versus a purchase of a business. So on the agenda today, first things first, I am going to get into the definition of a business. So thankfully, FASB has laid out a pretty solid definition here. So I will walk through that and the various frameworks to better identify if we are purchasing an asset or if we're purchasing a business. Then I'm going to walk into the key differences between those two. I will provide a couple of examples of a business combination and then a couple of examples of an asset purchase. And then I will also walk through a couple kind of what we should be disclosing as for each of those situations. So first things first, what is a business? So FASB gives us this definition down here, an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return. So it's a pretty generic definition, but I think the framework that ASC 805 provides, which I'll walk through on this following tab, can really give us a good idea of how to come to that conclusion. And obviously, this definition is very important as the accounting is going to vary significantly between the two. So the framework they use is called the screen test. So you're going to see in this first box right here, is substantially all of the fair value of the gross assets acquired concentrated in a single asset, or is it in a group of similar assets? So you're going to see substantially all is underlined here. That's because there's no great definition to it. But what FASB does is they're going to use that 90% rule that you'll typically see. So they're saying, I mean, as an example, if you're acquiring just one asset, I think it's pretty clear cut. If you're purchasing for manufacturing, as an example, if you're purchasing a machine, that's going to be a single asset. So obviously it does not qualify as business. But where it gets more complicated and where you may be answering no here and heading over to the output evaluation is if you're purchasing a building with several assets involved. So if you're purchasing a building with a couple machines included, laptops, maybe there's some other cash involved in the transaction, what you want to step back and ask yourself is, does the building account for 90% of the total fair value of the assets acquired? So if that answer is no, then like I said, you're going to step over here and evaluate does the acquired set of assets, does the acquired set of activities include outputs? So it's going to be a little stricter if it does not include outputs. They're going to make sure that you adhere to two specific criteria, which I'll go over here in a second. But if it does include outputs, it's most likely a business, and they only need you to meet one of the four conditions. I will say the conditions and criteria here really revolve around are you acquiring a set of employees, set of a workforce, or are you acquiring a process? So I'll dig into that here in a second. So a little more information on the screen test. So FASB put this together in an effort for the acquirer to walk through a process that is low cost and low effort to perform. They don't want people spending a ton of time trying to decipher if they're acquiring an asset or if they're purchasing a business. And then again, the end goal here is really to identify transactions that are not business combinations. It can be quantitative or it can be qualitative. And there's that substantially all kind of definition that they give you. Is 90% concentrated in a set of similar assets or a single asset? There are a couple of additional factors here. If you are kind of towing the line of 90%, you can look at goodwill. So obviously goodwill is not going to mean it's a business right off the bat. So they still want you to walk through the screen test. Also, same for distinct assets. If you're buying several assets that are not similar, they want you to walk through the screen test because it's not as clear cut as it could be. Okay, so some key definitions here. Like I mentioned, what really drives, if we're looking back at that screen test, on that right-hand side, once you get to the output evaluation, some key items here are, does the acquired asset have a workforce? Are there outputs kicked out? If there are, it is likely a business. So some pretty straightforward definitions here. So an input is an economic resource that creates or has the ability to create an output. A process is a system, standard, protocol, convention, or rule that aids in the creation of an output. And then an output itself is obviously the combination of those two items. Something that results in goods or services and creates revenue. So as I said, the framework varies based on whether there are outputs or no outputs. Once you get into no clear-cut output, it's going to be a little stricter. And I'll give an example here in a second. But when there are outputs, it's really not going to be that strict of a policy. It's very likely a business combination. Okay, so here we walk through the four set of criteria that were previously mentioned that would trigger, that kind of define what an output, define when outputs create a business combination. So an integrated set of assets or activities that will have an input and substantive process that create outputs are when any of the following are present. So as I mentioned, if there's a workforce in place that has skills, knowledge, if there's a contractual workforce in place that is helpful in creating outputs, but then also if there are processes in place that are hard to reproduce or replicate, if they're unique or scarce, then that would qualify as something that impacts an output and would be considered a business combination. On the other hand, if there are no outputs, this is where it gets a little more strict. To be a business, it specifically states that employees that form an organized workforce must have necessary skills, knowledge, or experience to perform the acquired process. But it also must have inputs that a workforce can develop and convert into outputs. I think a good example that I found here was when scientists are working on an R&D project. It's like at the end of the day, they aren't creating a very specific output, but what they're producing will lead down the road to an output. And they're also creating revenue by working through the R&D project. Okay, so some key accounting differences here when you're dealing with an asset purchase versus a business combination. So with an asset purchase, it's going to go through the cost accumulation model. I'll walk through an example here in a second, but if you think about it, you have to reevaluate the costs related to the asset. So if fixed assets are a portion of the total purchase price, you then have to recalculate what portion of the total purchase price they are, and then either write it up or write it down. And you would do that for each fixed asset or a specific asset that was purchased. Whereas with a business combination, it's going to be based on the fair value model. These both fall under scope 805. There is no measurement period for an asset purchase, whereas with a business combination, they do give you the opportunity to go back and recalculate or remeasure the assets acquired. So specifically, they state that you have the earlier of 1 year or when all relevant information has been obtained. With transaction costs, asset purchases are going to capitalize those transaction costs, whereas with business combinations, it's going to run through the income statement and be expensed. Contingent considerations. So think of an earnout. With asset purchases, you would recognize when the earnout can be reasonably estimated or it is probable. Whereas with a business combination, you're going to want to record that earnout the day of the acquisition date and then remeasure at a point when it's necessary and when it can be determined. So if you would need to meet if the acquired company needs to meet a certain EBITDA 1 year out, then you would record it the date of the acquisition, but then that 1 year out, you would go and remeasure because at that point in time, you would be able to determine if they met that EBITDA threshold. Goodwill is typically going to be recorded under a business combination, but you are not going to typically see goodwill recorded under an asset purchase. A couple more accounting differences here. So asset purchases, you aren't typically going to see a gain from a bargain purchase, but it is a possibility under a business combination. Contingencies are both, a loss contingency is going to be recorded under an asset purchase and a business combination. Under an asset purchase, it's going to be recognized when probable and it can be estimated, but you would not record a gain contingency under an asset purchase, whereas you could under a business combination. Intangible assets are going to be recognized at the fair value for both of these. Assembled workforce, there's a little different treatment here. Under asset purchase, it's going to be a standalone asset, but under a business combination, you're just going to work it up into goodwill. And then for in-process R&D, under an asset purchase, you're going to expense any R&D, whereas with a business combination, you're going to measure it at fair value as a indefinite life intangible asset until it is complete or abandoned. Okay, so some examples of a business combination. This can be relatively straightforward, but first off, at this point, you've walked through the screen tests and you've determined that what you're purchasing produces outputs, it has a workforce. So then you need to determine the acquirer, you need to determine the acquisition date, you need to recognize and measure the assets, liabilities, and non-controlling interest. And then step 4 down here, you need to recognize and measure any goodwill or gain from bargain purchase, because as we saw in that previous slide, that is something that could be recorded under a business combination. So these examples are relatively straightforward, but this first one is going to show you how goodwill can be recorded and how it can be calculated. So in this situation, the company paid $100,000 for a set of assets and liabilities. So they have purchased $85,000 worth of assets, and then they have assumed $20,000 of liabilities. This results in a total net value of $65,000. So if you paid 100 for it, 100 minus 65, you're going to get to your $35,000 worth of goodwill. This next example is just if the amount of the purchase was the exact amount of the assets acquired and the liabilities assumed. So you paid 65, the net value of the assets and liabilities is 65, so no goodwill needs to be recorded. The third example is if there is a non-controlling interest. So a lot of the same the same facts as the previous examples. But in this case, there is a second company here. So company B is going to pay 40,000, whereas company A is going to pay 100,000. In this situation is where you would record non-controlling interest for the portion on the controlling company for the portion that company B acquired. But in this case, there is still goodwill here because the overall purchase price was still $35,000 greater than the total, than the sum of the assets and liabilities. So the controlling company would then record $35,000 of goodwill. Okay, here's code word number 3, 443. I'll leave this up for a couple seconds. Okay. So now I'll walk through a couple examples of an asset purchase. This is a little more complicated due to the remeasurement of assets. So here you have purchased a single asset or a similar group of assets. So you've evaluated whether a business or a group of assets has been acquired. Step 2 would then to be determine the acquisition date, the initial recognition of costs, and any consideration exchange, transaction costs, or contingencies. Because as we previously mentioned, transaction costs are going to be capitalized in line with a purchase of an asset. And then number 3 is that's when you allocate the cost of the business based on the fair value method. Okay, so here is scenario 1. The key to note here is that the company paid $120,000 for $100,000 of assets. But within the assets was $30,000 of intangibles. So when a company pays more for the fair value, they cannot include the intangible assets within the cost of the acquisition. So you see over here in the third column that the cost of the acquisition is going to be calculated at $90,000 because it is excluding the intangible assets. So when you go to recalculate, you're only really looking at machinery and equipment and building. So for example, machinery and equipment ends up being 29% of the total cost of the acquisition because it's out of the 70,000 combined. So once you take the 29%, multiply it by the 90,000, then that's what you're going to write up the machinery and equipment, and you're going to write up the building too, which then gets you back to the final 120,000 that you purchased. So scenario 2 and 3 are going to have a couple different alternatives, but the key to look at here is that the cost initially was less than the fair value. So under scenario 3 that I'm going to switch to here in a second, you can include intangible assets. It gives you the option to include intangible assets within the calculation. Within this scenario, we're not going to include intangible assets. So it's a lot like the first scenario in that you're only looking at machinery and equipment and building, and you're basing the cost of the acquisition only on the eligible assets. So you end up writing them down in the end to get back to your initial purchase price. Whereas under scenario 3, we have included the intangible asset as an eligible asset. So you've included it here, you've included it in your percentage of fair value, and you've multiplied it by the cost of the acquisition to get back to your allocated cost. So you're able to write down intangible assets here. But based on scenario 1, when intangible assets are included and you've paid more, you are not able to write them up. Okay, so then lastly, some disclosure differences between an asset purchase and a business combination. So with anything, so we'll look at business combination first. So with anything, you need to assess it for materiality, individually and in the aggregate. So if the company obviously is over materiality, I think all these items should be disclosed. But if in the current year you've purchased multiple companies that end up being over materiality, I would still disclose all these items. So be very disclose disclose a decent amount of information here. So the name and description of the acquiree, acquisition date, if any equity interest was acquired, and then why did the combination happen? We also go pretty in depth in the notes to the financials on which assets and liabilities are assumed. I would include all assets line by line and then all liabilities line by line in order to get back to the total purchase price. Disclose all practical expedients and any private company alternatives used. Also disclose any consideration transferred, any gains, any related costs. So if there's any transaction costs that ended up going through the income statement, disclose them here. And then if there was any measurement period adjustment, so like we previously said, you can go back a year to adjust the fair value. So if there was any adjustment that needed to happen there, make sure to disclose that. And then for an asset purchase, what are the disclosure requirements? A lot of the same. You may disclose a reason for the acquisition, the amounts recognized as of the date of the acquisition, and then any information about separate transactions that help the user better understand the transaction. So it's definitely a little less is disclosed here than a business combination, but definitely still include it if it is material. At a minimum, GAAP does want you to disclose the balances of the major classes of assets. They also want you to disclose any intangible assets acquired and then disclose any loss contingencies or any non-monetary transactions. Okay, so that is all I had. If anybody ever has any questions on if you are going through a business combination or an asset purchase, don't hesitate to reach out to your contact at KSM. Thank you all.
Perfect. Thank you, Stu. That was great. I think it's always a great reminder to get a refresher on kind of the differences there. I know a lot of times, even the naming of the different agreements, you might have a purchase agreement that says purchase of assets, but that doesn't preclude it from being a business combination under the accounting guidance. So sometimes that gets a little sticky just depending upon how things are named as well. And really focusing on that definition of a business to get to different accounting answers. So the next part of our webinar today, I'm really excited to have Ben Phillips with us to kind of cover the finance role in vendor risk management. So Ben is a director in KSM's Audit and Assurance Services group, but primarily is a member of the firm's rapidly growing IT Risk Advisory Services group. So he works directly with clients to identify, assess, improve, test, and report on their internal controls. He's very well versed in a variety of standards and frameworks, including those issued by the AICPA, High Trust, and the National Institute of Standards and Technology. Ben is responsible for planning, execution, and delivery of SOC reports, high trust validation assessments, IT general controls assessments, internal audit services, cybersecurity assessments, and internal control consulting projects to meet clients' various compliance and internal control related needs. So Ben is overqualified to present with us today. He's just going to touch on a little bit of what he does and how that kind of works in with the audit. He is a frequent presenter and author on topics related to everything cybersecurity, risk management, SOC, and high trust. So thank you, Ben, for being here today to give us a little bit of your industry knowledge.
Thank you. Happy to be here. So hey, everyone. As Jessica said, I'm Ben Phillips within KSM's IT Risk Advisory practice. And today we're going to talk about finance's role in vendor risk management. So specifically, how vendor relationships impact internal controls, audit readiness, and financial reporting. So historically, organizations often viewed vendor risk primarily as an IT or a cybersecurity issue. Over the last several years, we've seen finance and accounting teams become increasingly involved because many critical financial processes now rely heavily on third-party platforms and outsourced services. The goal for today is to help connect the dots between vendor oversight, SOC reports, internal control, and audit expectations in a practical way. Let's see if I can do this right. Did I flip the slides right? I'm assuming so. Okay, so why does this matter across the organization? This issue has become much more important because organizations increasingly rely on software as a service or SaaS applications, cloud providers, outsourced payroll providers and processors, revenue platforms, and integrated financial systems. In many cases, key business processes are no longer fully operating inside your own environment. That means that risks become interconnected. IT issues can become accounting issues. Vendor outages can become operational issues. Security weaknesses can become compliance or financial reporting issues. So one of the big mindset shifts that organizations need to make is understanding that outsourcing a process does not outsource the accountability. Leadership, finance, IT, procurement, and operations still all share responsibility for ensuring that services are properly governed. And when things fail, the impacts can be broad. Inaccurate financial reporting can occur. There can be operational disruptions, compliance concerns, or there can be reputational damage. This is why vendor risk management has become a cross-functional governance issue rather than just a technology issue. So from an executive and audit perspective, this becomes especially important because vendors effectively extend your control environment. Let's see. You can outsource a process, but not the risk. That's probably the single most important concept in my session today. Organizations often assume that because a reputable vendor is handling a process, the associated risks are also fully handled. But auditors, regulators, customers, and leadership generally do not see it this way. If a third-party payroll provider processes payroll incorrectly, or a SaaS revenue platform has weak controls over financial reporting data, the accountability still ultimately rests with your organization. Vendors become an extension of your control environment. So when we think about internal controls, governance, and risk management today, we can't just focus on what happens internally anymore. We also have to understand what are vendors doing, how do their controls operate, and what responsibilities still remain with us as the customer organization. So a real world scenario. So this happens more frequently than not. So a company is using a software as a service revenue platform that processes transactions and generates financial reports directly used for financial reporting. Management of the organization obtains a SOC report from the vendor. So initially they believe that they're all good, but nobody at the organization really reviews it until the auditors ask, did you get the SOC report? No one validates whether the report covers a substantial part of the audit period whether the controls are relevant, whether the scope was relevant, whether there were exceptions, or whether the organization performed its required user entity controls. During the audit, the auditor determines that they cannot rely on the vendor because the organization didn't demonstrate sufficient oversight. This can lead to additional testing due to changes in control risk, delays in reporting, just more effort in the audit, and sometimes identification of further control deficiencies. So the key lesson is obtaining a SOC report is not enough, and there has to be active review, evaluation, and ownership. So what is vendor risk? And so when we talk about vendor risk, we're really talking about the potential for third parties or vendors to negatively impact your organization. And this impact can occur in multiple ways. It can occur financially, operationally, from a data or a cyber perspective, through compliance failures, or reputationally. And in many organizations today, vendors touch all of these categories simultaneously. For example, a payroll provider may process sensitive employee data affecting financial reporting, They can create compliance obligations and support critical operations all at once. That's why vendor risk management requires a broader coordination across multiple business functions. The key categories of vendor risk. This slide kind of breaks down vendor risk into several categories. Operational risk focuses on service disruption or downtime. Financial risk may involve transaction processing errors, billing inaccuracies, or failed reconciliations. Compliance risk often includes regulatory obligations, for example, privacy regulations or industry requirements or contractual commitments that you've made. Cyber and data risk includes unauthorized access, breaches, ransomware, or weak security practices. And reputational risk reflects the reality that customers often associate vendor failures directly with your organization. One important point to note is that these categories overlap heavily. A cyber incident can quickly become an operational disruption, a compliance issue, a financial reporting issue, and a reputational event. That interconnected nature is why vendor risk management has become so important. So now that we've talked about vendor risk, now let's talk about vendor risk management. Vendor risk management is not a one-time review performed during new vendor onboarding. It's an ongoing life cycle. So I'm going to use VRM as the acronym for vendor risk management today. So a strong VRM program typically includes identifying critical vendors, assessing the risks that they introduce, implementing controls, monitoring performance, and continuously evaluating the control effectiveness of those vendors. Importantly, it requires collaboration. Finance may understand financial reporting impacts. IT may be responsible for the cybersecurity impacts. The procurement group may manage vendor relationships. Legal is reviewing the contractual obligations, and operations of the organization understand the business dependencies. So no single department can manage vendor risk alone. The strongest programs are coordinated across functions with clearly defined ownership. So how vendor risk enters financial applications. So this is where finance and audit connection becomes very real. So many organizations rely on vendors for systems that either process transactions, store financial data, generate reports, or support core accounting processes. Examples can include ERP systems, payroll providers, billing platforms, revenue systems, and data integration systems. As organizations adopt more cloud-based financial applications, more of the control of the environment exists outside of the company's direct infrastructure. What that means is that finance teams need visibility into who's processing the data, how do the controls operate, and what responsibility remains internally. Otherwise, organizations can end up with just hidden control gaps. All right, so impact on financial reporting and controls. So this slide highlights the direct internal control implications. So many controls that support financial reporting may actually exist at the vendor. For example, system access controls, change management, transaction processing controls, backup and recovery controls, or interface controls. If those controls fail, the impact can include inaccurate financial data, processing errors, unauthorized transactions, or unreliable reports. One thing your financial auditors increasingly focus on is whether the organization understands where those controls exist and whether they properly oversee them. So management cannot simply assume that the vendor is handling everything correctly. There needs to be evidence of governance and oversight. So as it relates to identification of critical vendors, not every vendor requires the same level of oversight. And a key part of vendor risk management is identifying which vendors are truly critical. So this slide breaks that into three categories. Financially critical vendors impact financial reporting or transaction processing. Operationally critical vendors support core business operations where disruption would materially affect revenue or service delivery. And technically critical vendors support infrastructure, access, integrations, or system availability. In practice, many vendors fall into multiple categories. For example, a cloud ERP provider may be financially, operationally, and technically critical simultaneously. The reason classification matters is because it helps determine the level of oversight, the required assurance, monitoring expectations, and contractual requirements. So why this matters for an audit and internal controls over financial reporting. So this is where vendor risk management directly intersects with this. Auditors frequently rely on controls operating in service organizations, but they can only rely on those controls if a SOC report is relevant, the controls are appropriate, and management has performed adequate oversight. If there are gaps, the auditors may increase substantive testing, they may reduce their reliance on controls, or identify deficiencies. This often surprises organizations because they assume the vendor is just handling everything automatically and everything's all good. But from an auditor's perspective, the oversight responsibilities still remain with management. So strong vendor governance generally leads to a smoother audit and fewer surprises. Let's see, I think I got a QR code. Number 4, 597. I'll pause for that. And we'll get back to it. So now I'm going to briefly talk about SOC reports, the purpose and the value. So SOC reports are one of the primary tools organizations use to gain visibility into vendor controls. A SOC report is essentially an independent examination of a service organization's control environment. It helps bridge the gap between the kind of a visibility gap into environments your organization does not directly control. So more importantly, SOC reports evaluate both the design of the controls of the service organization or your vendor, and in many cases, the operating effectiveness of controls over time in a type 2 scenario. So for finance and audit teams, SOC reports often become a foundational piece of audit evidence supporting the reliance on third-party systems. But again, the report is only valuable if someone reviews it and understands it. So into the types of SOC reports, this is an area where it's fairly common to have confusion. A SOC 1 report focuses specifically on controls relevant to internal controls over financial reporting. And these are typically reports auditors care about when vendors impact transactions, processing, or financial reporting. SOC 2 reports are focused more broadly on something called the trust services criteria. This can cover security, availability, processing integrity, confidentiality, and privacy. SOC 2 reports are extremely valuable for broader vendor oversight and cyber governance. But a lot of organizations sometimes mistake and request a SOC 2 report when they actually need a SOC 1 report for audit internal control reliance. So understanding the distinction between the two is very important when defining vendor assurance requirements. So in light, when you receive a SOC report, the next challenge is knowing what you're getting and how to properly evaluate it. All right, how to evaluate a SOC report. So there are several key areas that an organization should review carefully. First is the scope. Does the SOC report actually cover the systems and services your organization uses? It's not uncommon for a large company to have multiple systems platforms or services that they offer customers. And sometimes SOC reports don't include everything. Sometimes they have individual SOC reports that include individual systems. So it's really important to read it and make sure that what you're getting matches what you receive from a SOC report. The second is the period coverage. So does the report align with your audit or your reliance period? Third is Third is relevance. Are the controls applicable to your processes and risks? Then there's results. Were there exceptions or failed controls identified? And finally, subservice organizations. Does the vendor rely on additional third parties like cloud service providers? And if so, how are those risks addressed? So one common issue we see is organizations just collect the SOC reports, but never perform a documented review procedure. Auditors will increasingly expect evidence that management has actually evaluated the SOC report and followed up appropriately. So common gaps in practice. SOC reports may be collected but not reviewed in detail. Second, there is often a misalignment between vendor controls and internal controls. Third, organizations sometimes over-rely on vendor assurance without understanding what the report actually says. And fourth, control exceptions identified in the report may not be investigated or addressed. So one important thing to remember is a clean SOC report or a SOC report with no exceptions, unqualified opinion, does not automatically mean that your organization has no risk. You still need to understand what your responsibilities are, implement your own controls, and validate how the vendor integrates into your own environment. All right, complementary user entity controls, or CUECs. So this may be the most overlooked concept in SOC reporting. So CUECs are controls that the vendor or the service organization expects the receipt of the SOC report or the user of the system to perform. These examples may include reviewing exception reports, performing reconciliations, validating data input and outputs, monitoring system activity, or managing user access. The vendor controls are designed assuming that your organization performs these activities. If you do not perform them, there may be a control gap. This is why we often describe SOC reporting as a shared responsibility model. The SOC report defines the vendor responsibilities and your responsibilities. It does not replace your internal control environment. This is an area that auditors pay close attention to because missing a CUEC can undermine the reliance on vendor controls. Let's see. So on contracts and service agreements, so strong vendor oversight starts long before the financial audit is being conducted. It often begins during contracting. So contracts should clearly define what kind of assurance requirements are you expecting from your vendor? Are SOC reports required or other forms of assurance? The reporting frequency of the type of assurance, the timing expectations of when are you supposed to get the SOC report, and remediation obligations. For critical vendors, you should consider requiring, annual assurance deliverables, such as a SOC report, defined response expectations for deficiencies, and clear accountability provisions. A well-structured contract helps avoid future surprises and creates leverage if issues do arise later. Without these provisions, organizations may struggle to obtain information needed for the audit or risk management purposes. Common contracting risks. So this slide highlights several contracting weaknesses that we frequently encounter. Sometimes contracts don't require any third-party assurance at all. Other times, the wrong report is specified. For example, SOC 2 is specified when a SOC 1 is actually needed. We also see timing misalignment when the report period doesn't support the audit period. And finally, contracts may not define accountability for control failures or remediation expectations. These issues often become visible during audits or incidents, which is more difficult and expensive to manage. So proactive contract language can significantly reduce these challenges. Audit considerations. So this slide summarizes how auditors typically evaluate vendor-related controls. The auditor will look at both the vendor controls and your organization's oversight activities, such as CUECs. They will evaluate whether the SOC report was relevant, whether the exceptions were addressed, whether the CUCs at your organization were implemented, and how vendor controls integrate into your broader control environment. When gaps exist or in these things, it can result in increased testing, audit delays, additional procedures, or control deficiencies. The important message here is that many of these outcomes are avoidable with proactive oversight and governance. Organizations that establish mature vendor oversight generally experience smoother audits and fewer surprises. All right, so what good looks like. This slide summarizes kind of characteristics of a more mature vendor risk management program. Strong programs typically include clear identification of critical vendors, documented SOC report reviews, CUECs mapped to the organization's internal controls, cross-functional ownership, and the contracts are aligned with assurance expectations. Importantly, maturity does not necessarily mean complexity. Even relatively straightforward governance processes can significantly improve visibility, accountability, and audit readiness. Again, the key concept is consistency and ownership. Let's see, key takeaways. So to wrap up, I'd like to probably leave with like 4 key messages. First, vendor risk management is a cross-functional responsibility. Second, SOC reports are important inputs, but they are not the conclusions. Third, your internal control environment extends beyond your organization. And finally, proactive oversight leads to better audit outcomes and fewer operational surprises. So organizations that understand these concepts are much better positioned to manage both risk and audit expectations in today's increasingly outsourced environment. So with that, my time comes to an end. So thank you so much for joining today. I appreciate everybody's time. If you have any questions after the session or would like to discuss vendor risk management, SOC reports, or anything else that I may or may not have talked about, please feel free to reach out or put a message in the chat. Thank you.
Perfect. Thank you, Ben. I always love when we get to break up our truly technical accounting topics with something that's equally important and sometimes is overlooked. So thank you so much for taking your time out today to walk through that. I think, those of us sitting on KSM side that are, on the auditor side of things, the increase in using, third-party vendors for some of these controls is really putting more of the, emphasis on what our clients, what are organizations doing to ensure that they're capturing the right controls when they think that, maybe the third party, now that we have a third party involved, everything's good, but it's understanding, I think that they're still just a part of the internal control environment. So as the conclusion to our technical topics today, I actually get to present. So we're going to walk through some recently issued accounting standards updates. As I noted earlier, my name is Jessica Boycourt, and I am a director in the Audit and Assurance Services Group's Technical Accounting Advisory Group. And so I work on a lot of technical research accounting projects, firm compliance initiatives, training, and internal quality assurance processes. I do work with clients with a focus on not-for-profit, government, and real estate, but primarily serving as a specialized resource and technical expert for clients and engagement teams to better understand both complex accounting and auditing topics. One way that I do that is actually being involved with the AICPA's Private Company Practice Section Technical Issues Committee that does actually meet annually with the FASB and with the Private Company Council, which I'll talk about a little bit later. So that's been interesting for me. I like doing this accounting standards update when I know some of these came out of discussions that I've been directly involved in the last 3 or 4 years. So that's kind of a fun little intro for something I do on a volunteer basis. But our objectives for this section are to summarize the recently issued accounting standard updates, and then we're going to do a brief update on the overall FASB projects that are out there. So first, for the recently issued accounting standards updates, at our last webinar in November, if you were able to attend, you'll probably notice that the first couple of these are repeat in the sense that the FASB had issued an exposure draft of the guidance, but had not issued the final standard. And then during November and December, they did actually issue final standards for these. So it could be a little bit of a review for the first couple of them, but we're going to go ahead and walk through these, as I know we have some clients in which this would apply to or could apply to, and the standards are not effective yet. So the first one is ASU 2025-08, and this is related to credit losses under topic 326 as it relates to purchased loans. So currently under the guidance, financial assets that are acquired through a business combination, an asset acquisition, or consolidation of a variable interest entity that were not a business are recorded at fair value. An allowance for the expected credit loss is separately recognized in accordance with topic 326, which you may think of CECL when you hear that number. And if that financial asset that was acquired had a more than significant deterioration of credit quality since it originated, then there was a separate section of the guidance called purchased financial assets with credit deterioration, or PCDs, and those are recorded using a gross up approach, which we'll talk about in a minute. But basically what this new standard had done that was issued in November of 2025 is expand that approach to some non PCD assets to make it more consistent and comparable in terms of how those PCD assets were being recorded and how non-PCD acquired assets were being recorded as it relates to the recognition of the credit loss being either reflected in the fair value measurement upon acquisition, or if they had a separate credit loss expense recorded. So this is kind of a specific area, but given that we're seeing an uptick in business combinations, you could see this come into play a little bit more. So the amendments in this ASU do apply to all entities. And we'll talk a little bit about this definition of seasoned loan. So I mentioned they expanded that PCD gross up accounting outside of the ones that had deteriorated credit. And they did that by creating this seasoned loans concept. So a seasoned loan is going to be scoped into that purchased financial asset accounting when it's considered seasoned. Well, what does that mean? It's any loan that's acquired through a business combination under topic 805, and also any loan that's being purchased more than 90 days after origination. So kind of think, they probably couldn't use the term aged loan, but just think of it as the older loans. So a seasoned loan is kind of a nice way to say that it's an older loan. And if that purchasing entity didn't have involvement when that loan was originated, then they can use this kind of gross up approach that aligns with the PCD accounting guidance that exists within GAAP. This walks through kind of what that recognition is and what that gross up approach looks like. So there, it's initially recognized at the amortized cost basis, which is the purchase price plus the initial allowance for credit losses. It's not then recorded separately. For interest income, that non-credit discount or premium on any seasoned loan is recognized as interest income. The allowance for credit losses on those seasoned loans will not be subject to a recovery cap anymore. And then there is an option to remeasure if you elect to aggregate that seasoned loan with existing financial assets that have similar risk characteristics. The disclosures, thankfully, do not change, but you would still be required to disclose anything that's required under topic 326 related to the credit loss, as well as what types of loans were purchased. The effective date for this is annual reporting periods beginning after December 15th, 2026. So that's going to be 2027 calendar year ends, but you can early adopt. If you're in an industry where you know you're going to have this, it does make the accounting a little bit easier. So it would maybe be something that our clients would be interested in early adopting. And then at adoption, you can only use a prospective transition method, kind of forward looking. The next update that they have out is ASU 2025-09, derivative and hedging, hedge accounting improvements. This amendment applies to all entities that have elected to apply hedge accounting. I promise that I did not intentionally tie these into the other topics that we talked about today, but it just happened to work out that way. The objective of this one is more closely aligning hedge accounting with the economics of an entity's risk management activities. There were five specific issues that were noted to the FASB when they were working on this project that really said we're getting different answers from what's actually trying to happen in these hedge accounting areas. So they're trying to make that a little bit more consistent across entities and maintain kind of where the hedge accounting guidance is being applied. I'm not going to walk through the details of this, but you'll get this in the slides. If you do engage in hedging transactions, you can look at these issues and see if they apply to you for this ASU. But there's the 5 different issues that the FASB looked at when putting out this new ASU. Again, we have a couple years on this one. Most of our clients are going to fall under that non-public business entities annual reporting periods beginning after December 15th, 2027 is when this would be effective. So 2028 calendar year ends, we have a couple years, but you can early adopt. So we like to get this information out there in case anyone with hedging transactions would like to early adopt. Again, it's a prospective transition method, which would be anything going forward. We just got a question about code word. Code word number 5 is 257. We do have the 6th one coming up in a minute too. It's always hard to place these consistently throughout, but code word 5, 257. The next one, ASU that was issued is 2025-10, which was on government grants received by business entities. So this was issued in December of 2025. It applies to all business entities, so it does not apply to not-for-profits or employee benefit plans. Clearly, not-for-profits have their own guidance related to accounting for grants, but prior to this ASU, GAP did not provide specific authoritative guidance about recognition, measurement, and presentation of when a grant was received by a business entity from the government. And so without that, there were a lot of entities, especially as we look back to, COVID, when there was a lot of for-profit entities that received government assistance. They were looking to international accounting standards, accounting for government grants by analogy, to be able to record those grants. So they basically took the concepts in IAS 20 and codified them into GAP so that we have authoritative guidance. There's 2 different methods here, but any government grant that this would apply to is defined as a transfer of a monetary asset or tangible non-monetary asset other than in an exchange transaction from a government to a business entity. It's important to note amendments do not apply to income taxes, benefit of below market interest rate loans, and any government guarantees. The government grant's going to initially be recognized when it's probable that the business entity will comply with the conditions of the attached grant and the grant will be received. There's 2 different methods for recognition. If I can get the slide to go, there we go. The deferred income approach or the cost accumulation approach. And so under the deferred income approach, when you meet that initial recognition threshold that we just talked about, the grant related to an asset is going to be recognized in the balance sheet as deferred income. Under the cost accumulation approach, you would recognize that asset in the balance sheet as part of the cost basis in determining the carrying amount of the asset. So for example, on that one, it's related to an asset, if they donated a building, then that's going to be placed, or a grant related to purchasing that building, that'll be determined part of the building, the carrying amount of that asset versus a separate asset. These are then both recognized into income on a systematic and rational basis over the period in which they recognize the related expense for which the grant is intended to compensate, or likewise with the, if it's part of an asset, then it would be recognized into expense kind of over how it would be amortized or into expense with depreciation, if it's a long-lived asset. The effective date for this, again, we're just going to look at those non-public business entities. This one's actually quite a ways out, with reporting periods beginning after December 15th, 2029. But early adoption is permitted, and I think in a lot of cases, people are taking this early adoption, particularly if they were already using an IAS 20 model that aligned with this. It's fairly straightforward in the transition method if you've already maybe been doing this. And it doesn't really change the disclosure requirements, as there was a separate ASU issued a couple years ago about disclosure around the government grants received by business entities. There were a couple of other updates issued in 2025 that were very narrow scope. Interim reporting is not something that very many of our client base in the private company realm do. We have a couple, but there were really narrow scope improvements there. And then pretty much annually, the FASB will update the codification for any just kind of language changes or other little changes. Nothing really major there, but those were the last two ASUs issued in 2025. So far in 2026, they've only issued one very narrow scope ASU. It was issued in April. It applies to all entities that issue paid-in-kind dividends on equity classified preferred stock. There was no authoritative guidance prior on how an issuer should initially measure paid-in-kind dividends on equity classified stock. So that was the guidance that they created. We don't see this very often, but if you do have this, then there will be specific guidance now that PIK dividends on equity classified preferred stock are going to be measured at the dividend rate stated in that agreement. I think in the past, people were using all different methods to do that and had a kind of diversity in practice there. This is also expected to create more consistency for earnings per share calculations. We don't have very many clients, again, that do earnings per share calculations, so I think this will more likely impact public companies. This one is a 2027 calendar year in effective date, but you could early adopt, and you can do prospective or modified retrospective application method. I know that was really quick. You'll have the slides. We will report on these again when they get closer to all of their effective dates. Reach out if you have questions. The last piece, which I'm just going to quickly go through so we can get to that code word, is the FASB has a lot of current projects going on their technical agenda, primarily because at the end of 2025, they went through an agenda consultation where they basically ask for feedback on what they should be looking at. So you'll have these next two slides in your packets. We're not talking about any of the projects in detail, but if you see something on here that you're particularly interested in, what the thought process is, reach out to me. I will be in Norwalk with the FASB in September, so can help push these along if you see something that maybe is a little more of interest to you. Very last thing I'm going to mention is the PCC. They work on private company matters specifically. When you get these slides, there's a link to their annual report and what they're working on. A couple of things that they're focused on now is ESOP accounting for ESOP plan sponsors, and kind of still looking at post-implementation items for leases. So if you have feedback there, the PCC is working on a couple of those projects. like, skip over my picture to get to our last code word number 6490. And while I leave this up, I want to thank Daniel, Stu, and Ben for presenting with me. I know it takes a lot of work and a lot of time to be prepared for this. Thank you all for joining us today. We've popped a poll up for those of you that are still around to help us inform our future Technically Speaking webinar topics. If you would please vote. If you add other, go ahead and put something in the chat or shoot any of us an email about what you'd like to hear about in the future. Our next Technically Speaking date is in December for our year-end ANA update. That will be on Wednesday, December 2nd. You'll get more information about that in the fall. If you submitted a question or something in the chat and you didn't hear from us, we will reach out to you after the webinar. CPE certificates will be emailed in the next couple of weeks. Remember to check out of the session and conferences IO. If you don't, we will have our L&D team help you out with that. But it's easier if you check out before you leave. Again, thank you for joining us, and we look forward to hearing from you and seeing you in December. Thank you.